Good morning from India, and thank you for joining us for this webinar series on illegal gold trade by Fintelekt Advisory Services and Global Financial Integrity. I'm Arpita Bedekar from Fintelekt, and I have with me Lakshmi Kumar, Policy Director from Global Financial Integrity, who's based in Washington, DC. Hi, Lakshmi.
Hi, good morning there in India, Arpita.
Thank you. Let me tell you a little more about Lakshmi. She has several years of experience working on issues of financial policy, securities, investigation, regulatory governance, anti-corruption, and AML-CFT. Prior to joining GFI, Lakshmi was a lawyer and policy professional in India, working with governments and regulatory agencies across South Asia, East Africa, and Eurasia to investigate MLTF risks to their financial systems. Her prior work includes drafting legislation to identify beneficial ownership for the financial sector in India, assessing and evaluating the robustness of the securities market in the Eurasian Group for the Eurasian Group on combating money laundering, and conducting investigations on sovereign wealth funds, procurement procedures, and other offshore investment entities for fraud and terrorist financing risks. She has a Master of Arts in Law and Diplomacy from the Fletcher School at Tufts University and a BA LLB from the Nalsar University of Law, Hyderabad in India. It's a privilege having you here, Lakshmi. Before we begin, sorry.
No, thank you. Thank you for the warm welcome.
Before we begin, a few housekeeping instructions for all the participants. This is a two-part webinar series. The second webinar will take place on next Wednesday at the same time. All participants are automatically enrolled for both webinars, and you can join using the same link next week. The link will also be available in a reminder that you will receive before the webinar next week. Today's webinar, as well as the one next week, will be posted on Fintelect's YouTube channel. And today, the chat feature will not be available, but you can post your questions in the QA box at the bottom of your screen. We will try and take up as many questions as we can in the last 10 to 15 minutes. So going back to the topic on hand, it is indeed a pleasure for Fintelekt to collaborate with GFI to bring you this series that aims to explore issues in gold trafficking as a key money laundering and financial tool for criminal groups. This series will be especially focused on illicit gold trade through India, Singapore, Africa, and the role of commodity trading hubs like Dubai, South Korea, and Switzerland. As you all may know, India is the second largest gold consumer in the world, consuming an estimated 690 tons of gold last year in 2019, next only to China globally. Gold prices have soared in 2020. A kg of gold today costs nearly 53 lakh rupees or $72,000. Moreover, trading in gold in India is highly cash intensive, making it a lucrative commodity for criminals and money launderers. In fact, illegal gold trade and smuggling has seen a spurt in recent years in India due to an increase in custom duty on gold, and also a differential between the import duty on refined gold, which is 10%, and the duty on semi-pure or door gold, which is 8%. And there have been some very high-profile gold smuggling cases, including one in July 2020, where 30 kgs of gold worth $20 million was seized from a diplomatic bag that was to be delivered to the UAE consulate in the South Indian state of Kerala. So I will hand it over to Lakshmi now, and in the first part today, she will speak more about the many factors involved in illegal gold trade and the risks for banks and financial institutions. She will also take us through the use of trade data and other financial tools to examine how the illicit trade in gold can be more effectively understood and tracked, and some investigative techniques to identify TBML risks as well as other red flag indicators of heightened money laundering risks. So it's over to you, Lakshmi.
Thank you so much. Thank you so much, Arpita. Just getting this, just a minute to get the PowerPoint. Yeah, there we go. So, the first question that's perhaps always asked is why gold? Why should we care about gold, and why is gold receiving so much attention internationally now? I mean, I think for everyone sitting in India, and especially sort of in India, Dubai, in Asia in general, the issues with gold, and especially with gold smuggling, is a decades-long issue, at least in India, going back to the 1970s, when India tried to pass sort of, legislation to restrict how much gold was held in private hands. So going back to sort of over 4 decades ago, there's a very clear cognizance of the role between sort of gold illicit trade and the loss of revenue from it. Internationally, in the last 10 years, gold has become much more the cynosure of attention. And the reason why is that, a lot of it has got to do with the risks and concerns around national security. Now, going back to the early 2000s, it started with the DRC, the Democratic Republic of Congo. There was a concern that gold is being used to fund armed groups, and therefore there is the need to restrict and monitor gold sales so that armed groups and terrorist financing groups don't have access to easy revenue. More recently, in the last 2-3 years, what has really especially got the attention in the United States is the role of gold in helping evade sanctions. I'm sure, as a lot of you know, the US has a very well-known sanctions regime, especially against Iran and now Venezuela. In the last couple of years, there's a lot of information that's come out about how Venezuelan gold and the Iranian government have used gold to help sort of mask their financial movements. And so this has again caused a resurgence in interest in the US as far as the use of gold to evade movement of money through the banking channels and to use alternative ways, because gold can both hide identity, but is also an easy way to hold value and transfer cash. Finally, again, internationally, gold is slowly being recognized as in its role with other criminal groups, for example, drug traffickers, organized crime groups. All of them have now started to use gold instead of sort of, just moving cocaine or other kinds of drugs, because gold is less noticeable. With gold, it's a lot easier to hide the illegality, because gold by itself is not illegal. When you talk about drugs, drugs are inherently illegal. Gold, it's legal. Its illegality comes from a variety of factors, including, how it was sourced, where it's coming from, who is financing the deal. So all of that means that there are many more opportunities in the supply chain to help obfuscate or sort of to hide the illegal nature of gold. Now, apart from this, there are several other factors that make gold a great tool. This includes the fact that, as I said, gold can occur anonymously. Once the gold has left its mining origin, every other point subsequent to that, becomes harder and harder to trace the identity of the gold, especially once it hits the refining process, because then it is no longer tied to a geography. It could come from anywhere in the world. Also, gold as a commodity passes through several hands from the time it originates from the mine till it maybe reaches India. It passes through about 10 to 20 hands, whether it's at the mine, at a national supplier, at the refiner, at the customs agent, at a commodity trader. And so because of that, it is very easy to sort of mask gold. Now, gold holds a lot of value. As Arpita said, this year, gold have reached record highs. And, gold, in terms of, if you look at sort of that picture on the side there, gold is that piece of gold, a gold that size, which is the size of like an army tag that soldiers wear, is over $1,000 US. Now, if you were trying to move $1,000 in cash or trying to do bulk cash smuggling, that would take up a lot of bags and suitcases. What gold presents is the ability to hide large amounts of value in very tiny, minuscule objects. And finally, that it is in itself, gold is a market that's very highly reliant on cash. Very often, when you're doing purchases of gold, you will often see that people trade in cash as opposed to sort of established banking channels. And this, especially the initial stage, when gold is mined before it makes its way into the world's global supply chain, all those transactions are conducted in cash, not through the banking system, which means it's very hard to trace its origins. Finally, what makes this sort of especially difficult is the fact that gold is a commodity that is in demand all over the world. Everyone wants it. And so you will see gold often move to 10, 15 jurisdictions, because it really underscores how interconnected global trade is. And that in itself helps the ease of movement of money laundering, because it is such a commodity that is in such high demand. Finally, there are no set due diligence standards and industry oversight that is binding on everyone. There are sort of, suggested recommendations like the OECD supply chain due diligence, but by no means are these binding, or sort of do countries mandate that has to be followed internally within countries. So all of this, and the fact that in a lot of countries actually gold is sourced, which is often in the developing world, the markets are very informal, which means it is harder to sort of put in place formalized standards. Now, as I said, gold prices have risen to lifetime highs. In July, an ounce of gold rose to a price of sort of about $1,931 US. Today's rate, speaking right as we are now, is about $1,900 US, which is a difference. However, as the rest of the world is experiencing a huge demand in gold, India, on the other hand, is experiencing its lowest demand for gold in 26 years because of COVID. As the prices have gone so high, there is no official demand for gold. But historically, if you look at India's trends, India's appetite for gold never goes away. What you often see in India is that once prices go high or it becomes too expensive, you will see an increase in smuggling routes. And so another way for gold to come in. But nevertheless, the Indian market in terms of sort of jewelry purchase and other purchases is witnessing a downturn just because of COVID, less spending income, more savings right now, higher unemployment rates, especially sort of, as we've seen COVID fallout with its effect on the rural segments, semi-urban segments. So notwithstanding this, India is still an extremely important market. And as we talk about the illicit gold trade, it is impossible to not factor India and the role India plays before we decide sort of international policy solutions around it. Just as a sort of a hat tip to sort of how important the issue is in the current climate is, FATF, as part of their COVID-19 risks to the global financial system, gold was one of the key commodities or key ways it was identified as a significant money laundering tool, which sort of tells us, how much attention the world is paying to it and how much attention that, those of us sitting at financial desks all over the world should be paying to sort of gold. Now, there's a question of who uses it for money laundering and terrorist financing. Now, as Arpita said, most recently we saw the case coming out of, Kerala, which saw over 250 kilos of gold that was moved through 19 flights between the UAE and India. Similarly, the FinCEN leaks recently showed that, Indian companies and Indian banks were sort of identified for gold illicit financing through sort of the Kalotri refinery in Dubai and its connections to a host of companies in India, which I'm going to discuss later. As I said, armed groups in the DRC, sanctions evasion, both sort of Maduro and Iran. Nicolas Maduro has, the US is particularly concerned because Venezuela is airlifting gold. So Venezuelan gold has been found in Colombia, Uganda, the Curacao, which are Dutch Caribbean islands, Lebanon. So you see pockets of Venezuelan gold making its way to places also where there are no trade transactions or no trade relationships of previously. Colombian drug trafficking organizations, including the Clan del Golfo, the FARC, which are both also, they produce a lot of cocaine in Colombia, but now they've moved to sort of the gold sector as a way to sort of merge their two businesses. And India gets a lot of gold from Peru. And Peruvian gold has been found to link to organized crime as well as human trafficking. There's a lot of cases of sexual exploitation that is tied to gold mining regions. And so you see a host of individuals involved across all over the world. And, given India's central role, almost each one of these has a connection that can be traced back to India. And as you see, the list of crimes that use gold includes deforestation, human trafficking, drug trafficking, to fund governments that, want to keep are not democratically elected, but want to keep a stranglehold on power, corruption. And in India's case, it's the last four that are of particular concern to India, which is macroeconomic stability, trade misinvoicing, the ability to subvert or get around India's, or to exploit India's free trade agreements, and finally exploiting the banking system, which is trade finance fraud. Because as we will discuss through the course of this presentation, what really sets apart the illicit gold that moves through India versus other parts of the world is the involvement of the banking sector. Because in many other parts of the world, the gold sector is not as well supported by the banking sector, because trade finance is not always the necessary component to sort of help the import and export of gold. Whereas in India, we really see how much banks are involved. And so apart from the macroeconomic stability, there's also a huge risk to banks themselves and the services they provide, because of the level of fraud that we see. There is a huge risk to sort of the compliance teams and due diligence teams that Indian banks witness. Before we sort of get to this, I wanted to sort of do our first poll question. So Karishma, Arpita, if we could sort of set out our first poll question, that would be great.
Sure. So how often do you use trade data to further due diligence, fraud detection, or compliance work? And you may choose between frequently, sometimes, rarely, and never.
So while we hold, the reason I wanted to do these poll questions is to get a sense of, because, we've been doing this webinar sort of in a variety of jurisdictions, and we see how much sort of, both the private sector and government sector rely on both financial data and trade data. Because especially when we talk about sort of the illicit gold trade, what really is critical is the use of both sets of data. So it's always interesting to see, depending on the jurisdictions that we are talking about this issue, what role trade data plays in sort of compliance and due diligence.
Sure. Shall we stop the poll and display
Yeah.
the results? Here.
This is interesting, because it says about 36. It's interesting that it's evenly split between frequently and sometimes. What I will say is that on the whole, this is better than some of the results that we have seen sort of on the US side of things, which is a much lower preponderance of use of sort of trade data, especially amongst the banking sector, to see it. So, but that this is, and I'm interested in sort of, I'm interested that it's evenly split between frequently and sometimes. And in an ideal world, as we talk about sort of, especially the movements of commodities in trade finance, I hope by the end of this webinar to make the case that there is greater value in moving the other 36% also into the frequently bucket. So moving on. Now the question is, why does this matter in India? Why should we care? As Arpita said, India is one of the largest holders in the world of gold. It is one of the largest consumers, and India has been consistently trying to sort of reduce gold imports because it affects India's current account deficit. Because a lot of India's foreign exchange goes into buying gold because of, the insatiable need by sort of the local population to acquire gold. So for example, the US, which has the largest gold reserves in the world, has over 8,000 tons. India's gold reserves, at least what the government holds, are only 618 tons. However, India's annual demand year on year has been sort of 750 to 800, and this is just an estimation. But privately, it's estimated that Indians hold anywhere between 20,000 to 25,000 tons of gold. Further figures to sort of emphasize this is that about 700 kilos of gold every year is smuggled into India. And annually, these estimates range at sort of 150 to 200 tons. So a lot of these sort of estimates were done by sort of GFMS, which is the Thomson Reuters outfit, which looks at sort of Indian gold trade. So I having looked at that, I looked to see what could be India's losses through custom and other revenues if we looked at this 150 to 200 tons. And that is around, if you take the upper limit, it's about 9.8 billion US dollars is just smuggled gold coming into India. Now, just to give you a sense of the scale of money laundering in India, which is a calculation I did, because the UNODC says money laundering globally is between 2 to 5% of global GDP. So looking at India's GDP, the size and scale of money laundering in India is anywhere between 5.75 trillion to 14.375 trillion, and 9.8 billion of that is smuggled gold. This is notwithstanding gold money laundering that occurs through regular trade that can be captured. So 9.8 billion is just transactions that are not coming out through India's trade transactions on gold. So you can see the size and scale and value that gold will have in India's as a component to India's money laundering. The last thing that is really critical in all of this is the role of the banking sector. As I mentioned, when we talk about the US market or European markets, you don't see the role of the banking sector, because in India, a lot of our illicit gold trade is deeply tied to sort of round tripping of finances, as well as other kinds of money laundering and trade-based money laundering schemes. And with all of this, these are usually financed on the back end through a letter of credit or other trade finance documents that are provided by the banks to what are considered sort of legitimate entities that are export-import businesses of gold. So there is a huge risk, not just for macroeconomic stability, but also to the Indian financial system. And as the Nirav Modi and the Punjab National Bank case saw that, it nearly sort of it nearly upended, in many parts of the Indian banking system, which the government then had to step in. So there is the real sort of risk, which is different from almost every other part of the world, which is the risk to the financial system, the risk to the banking sector as well. Oh yeah. Yeah. So now, as we talk about this, the one thing that struck me and which I thought was really interesting is the differences in money laundering perception and money laundering risks between the US and India. And this is really important because the perceived risks that the US sees, or sort of, that the US and Europe see, is what is now crystallized to become international standards that govern the illicit gold trade. And there is almost this, it's almost that either side looks at blinders. India and China are the largest markets in the world for gold, but the money laundering risks that affect India and China for the gold sector are not translated into current international standards on the illicit gold trade. And vice versa, the way that Indian policy and Indian regulation looks at gold risks is not as deeply attuned to sort of the way the US, Europe, and the OECD are moving. So there is clearly a room there is a need for sort of greater consensus and an ability to see risks that sort of the other side is not seeing. For example, as I said, in the US, the focus is on the role of gold in transnational organized crime, which is drug trafficking, armed groups, terrorist financing, the role of gold in sanctions evasion. So its role with governments like Iran, Venezuela, its use as in TBML schemes as drug traffickers. When we talk about US TBML schemes, they are talking about schemes that do not involve the banking sector. These TBML schemes essentially, which says that, let's say I am selling, I'm trying to move my drug money. I'm sort of hiding the drugs inside used cars, shipping them from, let's say, UAE to India. And so it is the value of drug sales is being masked as used cars that are then shipped to India. And then when in India these used cars are sold, that is the realization of drug proceeds. Whereas in India, when we talk about TBML schemes, very often you're talking about a falsification in the letter of credit, a falsification in over-invoicing or under-invoicing of a trade transaction, which is supported or which is financed by a bank loan or a bank trade finance document. So there is such a difference. In the US, there is a clear focus on the supply chain, which is where is the gold being sourced from, how is it coming through the US, and who is importing it in the US. Now, it is predominantly looked at through the lens of national security. In India, when we talk about money laundering risks of the illicit gold trade, it is primarily focused on threat to India's macroeconomic stability and the Indian financial system, which is a lot of it is focused on India's current account deficit, because the Indian government for the last 30, 40 years has been concerned by how much of its foreign exchange cachet is being used to buy gold. And so a big part of India's policy towards the gold trade has been to deter private private investment into gold, which is to deter imports of gold into the country. Its focus is on loss of customs revenue, round tripping of funds, which is a way so that, to create foreign direct investment, even though there is no foreign direct investment. TBML schemes in India are predominantly, as I mentioned, through focus on the role of banks. It's focused on smuggling through Indian airports. It's focused on the abuse of free trade agreements, which is something I'm going to touch upon, which is the role of South Korea in all of this. So it focused on clearly the macroeconomic consequences. Even when India talks about smuggling, we're not talking about, okay, where does this gold come from? Is it a problem that this gold comes from a place where it might be funding terrorism? The Indian case of Kerala, the reason we were concerned about terrorist financing there was because it was used to finance terrorism, possibly in India. But in the way India perceives money laundering risk is it was never a concern whether the gold, when it was coming from the UAE, was using to finance terrorism elsewhere, not just in India, but finance terrorism. So there is this clear distinction and between the way risks are perceived. Now there's the sign of what is ignored on either side. As we talked about the differences in perception, the other side of that coin is what each side is ignoring. Now, for example, in India, when we look at the risks of money laundering from the gold sector, a large part of it, or the focus of it, is not about the origins of the gold. Whether the gold is coming from a drug trafficking gang in Peru, whether the gold is coming from a terrorist outfit, or whether the gold has been shipped from a country where there is armed conflict, like the DRC, or whether it might be used to support conflict or a government that is corrupt, which for the longest time there's concerns about Sudan. So, in that sense, a lot of the focus of the thrust of the policy has been around around customs duty. So it's not focused on the OECD due diligence and supply chain risks. This is not to say that, there isn't slowly attention being paid, but just to say it's not the focus of the policy. Similarly, there's not as much focus on refinery certification, because a lot of this gold that comes to India comes from all over the world. And is there necessary impetus to make sure that the refinery where India is getting its gold from has appropriate certifications to say that, okay, it responsibly sourced this gold. It knows it's not getting its gold from criminal actors. India, as the largest consumer of gold and also such a key player in the global jewelry market, only really has one organized refinery that is up to international standards. So there is that huge gap in India's perception. On the other hand, the US, what it does not look at is the fact that the US policy around gold is entirely focused on where the gold is coming from, who is manufacturing it. What it does not necessarily look at is who is financing the acquisition of gold. So there are often cases where you will see someone who was financed by a refinery in Dubai, who went to source gold in Peru, and Chile. When they sourced the gold from Chile, this was a person with no experience. They were able to get $5 million as a loan to help finance the gold acquisition operations. If that individual, a person called Harold Wilches, had gone to a bank, they would have had to do AML due diligence. In this case, the gold refinery, which is backed by a bank, provided this financing, but did not do AML due diligence, nor was it required to do. So the US approach really ignores who finances a lot of this and where the money is coming from and where policy prescriptions should lie. Similarly, the distinction between the two markets is that a lot of banks in the US are moving out of commodity trading. So you instead see private equity stepping in. There's a very famous case in the US of the Oko Zif hedge fund, which was fined $100 million because they paid close to 400. They were fined for $400 million because they paid over $100 million in bribes to acquire illegal mining rights. So we also see this movement in the US of banks no longer sort of helping finance the gold trade or the commodity trade, but it moving to private equity. And hedge funds in the US do not have anti-money laundering due diligence requirements. Similarly, there is sort of very little focus on money laundering for capital markets or the bullion gold. I think a lot of people are familiar with sort of the Danske Bank case, which apart from the many gifts that the Danske Bank case has given us, the one thing that it also did was it showed that bullion gold, which is considered extremely low risk because it's gold that is held in banks, was sort of Russian kleptocrats or oligarchs who, where the origins of funds were not known, were allowed to sort of, purchase this gold and hide their sort of illicit monies in it. And Danske Bank had a scheme through which they acquired this gold from an Austrian gold refinery and helped facilitate this for sort of these individuals who had suspicious, who were without a clear origin of funds. So a lot of that is missing. And finally, I think for everyone that is sitting on this side of the hemisphere, progressively what is happening is that gold is again being subject to de-risking policies. Because the focus is on the origins, and the origins of gold are always tied to developing countries, what you often see is a lot of institutions saying we will not deal with gold that comes from the developing world. We will not deal with gold that is not from a large multinational corporation. So, it is another way you see de-risking being perpetuated. So before I go on to the next section, I think I wanted to sort of set it up with the next poll question.
Sure, this is the second question, and this is a multiple choice one. What kind of due diligence information does trade data provide you with? And you can choose as many options that apply to you. Address of buyer and seller, name of legal entities importing and exporting, destination, origin, quantity, price and volume, port of entry and departure, mode of transport, air, land and sea, and the beneficial owner.
And so the reason I ask this is it's interesting to sort of see what kind of information it can give you, because I think a lot of people assume that this can provide you a certain amount of information that financial sort of data can provide. So I'm always interested to just, and also to tell you why these pieces of information are critically important in terms of sort of helping understand money laundering risks.
Okay, let's get the results published.
Okay. This is interesting. Again, I'm really impressed by sort of, this is in some ways a trick question, so I apologize for that. The truth is trade data can provide you almost everything except the beneficial owner information. It can tell you the address of the buyer and seller, the parties to either side of the transaction, where it is going, the origin, the quantity, price, volume, port of entry, departure, the mode of transport. Now, each of these pieces of information are critical in helping you understand where the money laundering risks are and why they should raise red flags. Now, beneficial owner is the one thing trade data unfortunately cannot provide. India has the rare exception where the Customs Act now requires beneficial ownership information to be captured and recorded. The efficacy or how successful they've been, that is a separate issue, but India is the one country, almost no other country in the world requires beneficial ownership to be captured at the customs level. And I think one of the critical pieces that we're trying to advocate is that for this to be truly successful, is that beneficial ownership should not be just available on the financial side of things, it should be equally available on the trade side of things. So with that, let's move on to sort of why does this matter in India? When we talk about trade and where this comes from. This is a sort of a snapshot of where India's gold comes from between sort of 2015 to 2018. A lot of it comes from Switzerland. to a portion we get from sort of the UAE. And what is interesting is year on year, India's imports of gold have increased from places like Ghana, Burkina Faso, and Peru. So when we're talking about a value of 130 billion US dollars, even a 0.2% increase is in the millions of dollars, and therefore it can also mean a risk in the millions of dollars. Okay, so yeah. Now, by contrast, you saw where India gets its where India imports from. India's exports of gold almost entirely go to the UAE. And you know, if you sort of move my face, which is blocking something here, you can also see that while the largest percentage, over 90%, goes to the UAE, smaller percentages go to sort of Australia, Hong Kong, and sort of other parts of the world. Now, what is interesting is if you look at India's exports and imports, for most other countries, when we talk about sort of the risks to money laundering, you often only care about, okay, where is this gold coming from? Because they are worried about the origins of the gold. You want to make sure you're not helping by buying this gold. You want to make sure you're not financing illicit activity in the place of origin. India is unique in that because India's risks stem not from just where India is buying the gold, but because a lot of India's exports are actually just fictitious trades. Some estimates, as I will show later, show that almost 78% of Indian gold exports are actually just round-tripping mechanisms. So they're essentially just a way to create fictitious foreign direct investment, which is just another money laundering scheme, which is why where India is exporting is just as important. And one of the things what is interesting, this ignores, is when you look at India's exports, and this is why I mentioned that even a 0.2 difference makes such a big difference, is you will see the UAE, which is a big risk for India in terms of round tripping. You will see Hong Kong. But amongst India's top exports destinations, you will not often see Singapore come up. You will not see South Korea come up. And in the recent 3-4 years, when you talk about round tripping of India's gold exports, both those destinations play a critical role. So this is why sort of even at a 0.% difference, there are millions of dollars involved in these destinations, even though they're not immediately obvious. I think a knowledge of India's sort of previous round tripping schemes should automatically draw these countries in as high risk. So sort of, taking a snapshot look of what the value of Indian gold exports are, you can see sort of, year on year, 99% and over goes to the UAE, and this is valued in the billions of dollars, going up to sort of, at the highest 2.27 billion. Now, Indian gold imports, by contrast, you can see Switzerland year on year, without question, 19 billion at its highest. Going at its lowest 13 billion. Similarly with Ghana and UAE, we're again talking in the billions of dollars. And the question is, why should these trade numbers matter to us? Why should we say, because on the face of it, it's just Switzerland, Ghana, and the UAE. The truth is, then you start looking at where does UAE gets its gold from, because that's what tells us where India is really getting its gold from. The UAE is the top 5 import destinations of gold for Switzerland. So not only is India directly importing gold from the UAE in a very convoluted way, if you take it one step further, a lot of the Swiss gold that India is importing is actually UAE gold that is coming in. And there's the question of, if you go one step further, our research shows that where does UAE get its gold from? The UAE gets its gold from places like Switzerland, again, so you see another loop here, places like Venezuela, as I mentioned. Till 2018, you could have trade transactions. So you could see there's no gold coming in from Venezuela. 2018, there's over $1 billion of gold going from Venezuela to Dubai. Once the US started caring about sanctions evasions, you do not see Venezuelan gold officially recorded anywhere. Anywhere in the world, you will not see official records of Venezuelan gold. Instead, what you see is private aircrafts flying gold. So you see that similarly, Uganda and Mali, which are other high-risk jurisdictions for gold, all send their gold to the UAE. Now, if you sort of piece this further, and then you look at sort of where does Uganda's gold come from, just as an example, you can see that Uganda's gold production is only 24 kilos, but its export quantity is over 1,900 kilos of gold. This is statistics I took from Uganda's official government data, and these are official trade records. So you see there is a huge mismatch saying when no one knows where this gold comes from. The long and short of it is that the problem with gold, for example, in a sanctions evasion scheme like this, is that, for example, let's talk about Venezuelan gold. Gold from Venezuela first makes its way from, sometimes from Venezuela to Colombia. In other cases, you can see the gold from Venezuela is going straight to Dubai. From Dubai, it's going to Uganda. From Uganda, it goes back to Dubai. From Dubai, then it goes to Switzerland. And from Switzerland, it goes to the US, but also from Switzerland, it goes to India on this side of the equation. So you're seeing that sometimes by the time the gold gets to India, from its place of origin, there are almost 5 degrees of separation from the point of origin, which means that even at one degree of separation, you know where the origins of gold are. By the time you hit the 2nd degree or 3rd degree or 4th degree, you don't know where this gold is coming from, but it is recorded as Swiss imports. But there is a huge risk that essentially you are, by importing this gold, helping in sanctions evasion or helping in sort of an international violation, and which is why gold is particularly interesting, because gold has this ability to erase its history and origins. Could we do sort of the, and before we get into sort of the final piece of it, I wanted to sort of do the last poll question.
Sure. So where do the majority of international transactions you monitor or vet come from? And there's a set of regions that you can select from. And I would urge all the participants to vote, to participate in this poll.
No, and I think, the reason I sort of emphasize this is that, depending on which regions you're monitoring, the availability of trade data is very different. So, and I think that tells you sort of access to information. So, which is why I'm sort of interested in some regions, there's just not a lot of very good trade data, and that affects your ability to use trade data to sort of monitor money laundering risks. So I'm interested to see what they come up with.
So let's publish the results.
Okay, so a lot of it comes from the Middle East, which is not surprising. So this is just to sort of give you an idea about it. There's a lot of good, usually sub-Saharan Africa doesn't have the greatest broken, well-defined trade data. Latin America actually has fantastic trade data. The Middle East can get a little bit complicated, especially with the UAE. It can be hard to get trade data. A lot of Asian countries, India especially, has excellent trade data. So, the thing is, the Middle East can be sort of a difficult transaction place to get trade data, but this doesn't mean that from on the Indian side, you can't get trade data to understand the Middle Eastern side. So even if one side is not providing adequate data, the other side can get it. And so I think that especially for people that are sitting in India, the fact that India does sort of a fairly good job with trade data means that there's better access. Now, so finally, we've talked a lot about the origins of where gold is coming from and why that's problematic. But once gold is in India, the export process itself is also a money laundering risk. So in India, both the import and export are both huge money laundering risks. And India is traditionally always focused on sort of the exporting money laundering risk, because the importing money laundering risk is primarily seen through the lens of smuggling. So with that in mind, what is round tripping? Round tripping just very simply means money which starts at one jurisdiction comes back to the same point of origin, which means, money that leaves India goes to a foreign country, but comes back to India. But what this scheme does is that it pretends that it's actually new trade transactions, that it's a different kind of import-export which, inflates India's import and exports. When reality, it's just the same, 200 kilos of gold that are going from X to X star back to Y, as opposed to sort of, an actual value add. So as far as gold, what you often see is that you will often see gold jewelry being sent as coins or as jewelry to a location like, let's say, South Korea, being re-imported back and then being turned into sort of gold bars and then being exported. Now, the motives for this are sort of, very, very different, but predominantly in India, when we see gold and round tripping, it is used to primarily inflate how much trade is going on. And, by falsifying the kind of trade transactions, it allows companies to get cheaper financing or secure better financing from banks. Now, you were trying to get my slides to move, and for some reason they will not. So excuse me for a moment as I try to sort this out. Okay, there we go. What is round tripping and how does it affect? As I said, round tripping, this is an example of sort of how round tripping affects India, which is, a very common example is you see a shell entity set up in Mauritius. Money, FDI outflows go from India to Mauritius, and then they make its way back to India as FDI inflows, when in fact it's the same money going from India which is coming back through Mauritius entity. Now, if you look at, depending on what it is that you're doing, GFI's analysis has shown that it can be used to sort of move money abroad. It can be used to avoid customs duties. It could be sort of to avoid sort of, the provisions of the foreign exchange FEMA provisions. So there are multiple reasons. In some cases, this is just to hide black money. So you're trying to hide your identity. And in some cases, it's because you're trying to get access to better capital that, might be harder to get in India, or because there are preferential treatments through foreign trade agreements that incentivize overseas investors as opposed to domestic investors. People want to capitalize that on and to sort of pretend that they are overseas investors. Now, with gold, what is truly, truly fascinating is that 78% of all gold imported into India for export purposes is used for round tripping. In 2018, 176 tons were for round tripping, and only 50 tons of Indian gold exports were actually for genuine exports. Everything else was for, so the majority of Indian exports, which I showed you, over 90% which goes to UAE, almost all of it is for round tripping. In 2017, this shows you how much the numbers have grown. Year on year, India's round tripping through gold has increased. 2017 was only 157 tons. In 2018, it's shot up to 176 tons. And a lot of these are just estimates there, but it's impossible to calculate. There is a wide range on this. But it just shows you the scale through which Indian exports are falsified, and a lot of Indian exports are backed by letters of credit and bank loans and bank guarantees. Now, this is the interesting case of sort of South Korea and India. India signed a free trade agreement with the South Korean government in 2009. Essentially, this allowed sort of duty-free import of gold from South Korea. But it applied to only sort of finished products, which is gold coins that would reach the end consumer. This is not sort of, for any gold that could be sort of, had to be refined or had to be changed over. Essentially, what was drastic was that gold imports from South Korea between a 2-month period was $339 million US. By contrast, for the whole financial year of 2016 and 2017, India only had 70.5 million of gold imports. Now, when we go to the next part of this webinar, we're going to focus more on how this scheme interplays with India's customs duty, the value-added tax, India's FEMA regulations. But because I don't want to complicate this, I want to sort of in the simplest terms explain this, which is simply that the way, even if you knew nothing about India's trade regulations, what was clear in this scheme is that the Indian-based company would use a parent or a sister company in the UAE, Singapore, or Hong Kong to send gold to South Korea. And from South Korea, this was then, which came to India as gold coins, which was then imported as gold coins. And then in India, these gold coins were then melted down and then sent back as exports, as gold bars to other parts of the world. And this allowed Indian companies to make the benefit of, to get around customs duty, get around the FEMA regulations, get around paying sort of, VAT and other cess duties, but more importantly, also sort of, get around to abuse the provisions of the free trade agreement. If you look at this slide, it might seem that the Indian, if you didn't know about the intricacies of India's laws, why should this scheme seem suspicious? And so I'm going to just, this scheme in 2017, India's imports from South Korea for what was, this particular HS code, which is gold metal products, was 99.8% of all imports just for the year 2017. Our analysis shows that from 2015, which is 2 years ago, India's imports for the same does not feature South Korea anywhere. It shows the diversity of locations where the gold metal products are coming from. If you look at 2018, a year after this scheme was detected, it shows that again, the diversity of locations through which India's products were coming from. So the only time you see an absolute block where India's gold metal products are coming from one location was at the height of this scheme before the Indian government intervened. So if you're a bank, then the question is, how should you have detected this? One, it would have been to sort of just keep a note of sort of where India's imports are coming from between successive years. The fact that you're seeing such a huge spike in from South Korea that previously never featured is a huge risk factor. Second, because this is such a new thing, you would have seen a lot of these companies that were formed and registered in South Korea are actually very new. They previously didn't exist because they were created very often to facilitate the scheme. Also, the companies, between India, UAE, Singapore, Hong Kong, and South Korea, all of them were either subsidiaries, they were related to each other, or they had very significant trading relationships. So even not knowing the intricacies of India's customs or tax laws or foreign exchange laws, just looking at the trade transactions alone would tell you why this was such a high-risk suspicious activity. And we're going to go back next part of this webinar to do an in-depth dive into this, as well as India's 80-20 gold money laundering scheme and the Nirav Modi scam, to talk about sort of how these trade data can interplay with India's sort of more specific customs and foreign exchange and free trade agreement rules. Now the final thing I want to do, which I'm not going to take too long with this and take about 2 minutes, is that the FinCEN leaks, it's covered the globe, but one of the places it also covered more than anyone else, it covered India's gold trade. A series of companies, the Delhi-based Met Trade, Jay Gurudev Industries, Balfe Jewelry, and sort of the Surana Corporation were all had SAR reports because of sort of their suspicious trading activities with gold. Of note is Jay Gurudev, which was received 65 suspicious transactions, which was a company that had nothing to do with the gold sector. It was entirely involved in the trade of sugar, rice, agricultural commodities. Similarly, Balfe Jewelry, which is based in the UAE, conducted 5,000 transactions that were valued at over US $2.78 billion. And the reason the SAR was filed is they could not place the origin of these funds. What I did is, subsequent to all of this, I went and looked at the trade transactions, and this is to show you the value of them, of Jay Gurudev and Balfe, to see, are they continuing to do any kind of illicit activity, or were the SARs justified? Now, if you look at Jay Gurudev just for the year 2019, you can see all the things that they're shipping. Cane sugar, they're shipping dal, a lot of dal in fact, mostly dal it would seem, and a lot of sugar and dal that they're shipping to places like Sri Lanka, India, and also Pakistan. And so the question is, why were they receiving gold payments? So on the bank side, if they were sort of receiving payments for gold or getting in a letter of credit document or any kind of financing arrangement for gold, the trade transactions over the last 2 years or 3 years or 5 years would have shown you would have shown you that Jay Gurudev just should not have, and that was a clear red flag. Similarly, with Buffalo jewelry, this is more recent transactions. One of the things, the reasons why SAR was filed amongst some of the other Indian companies is they had $0 transactions. What that means is that, for example, you see that Buffalo in UAE is shipping gold to Vogue Jewelers in Sri Lanka, and these are sort of more recent transactions. You can see from sort of, halfway down the screen, all the transactions going, the value in USD ends in perfect zeros. If you go to your regular supermarket and you're buying a product, your bill never ends in a perfect zero. It ends in point something, point something, point something else. And that's because, the price of gold is point something and the weights are not, none of it is whole numbers. So the fact that you see all these, almost nearly all transactions going to Sri Lanka currently, well after the FinCEN leaks, still having these same low numbers is a sort of a sign that there is a money laundering transaction. There's a money laundering risk here. And if you look at one of the things that was a reason that was filed against one of the Indian gold trading companies was that there were several large round dollar transactions. And that in itself is a risk because that's not how commodity trading works. And if you go back to Buffalo Jewelers today, you see the same types of risks. This right now was just to give you a snapshot of the different trade tools and trade mechanisms. I don't want to, and I think the next part we'll talk about how these interact with sort of India's policies around it. Thank you again, Arpita, so much for this. I look forward to sort of part 2, and I hope people are just as engaged.
We do too. So thank you to all the participants for your time today, and do join us for part 2 next Wednesday, that's October 21st at again 11 a.m. India time. And we'll discuss the policy options for the government and the private sector to address the risks of TBML in the illicit gold trade. And of course, the effectiveness of ongoing policy measures. As I mentioned, there's no need to register again. You can join using the link that will be sent to you in a reminder email next week. Meanwhile, if you do have any comments or feedback or suggestions, please do email us at contact@fintelekt.com. So we'll see you again next week. Have a great day ahead and a great week ahead. Thank you, Lakshmi. Bye-bye.
Thank you. Bye-bye.